On the first Tuesday of February 1637 in the Dutch town of Haarlem, an auctioneer was trying to sell a few tulip bulbs. He kept lowering the price. Nobody bought. A few weeks earlier, a single bulb had sold for 10 times what a skilled craftsman in Amsterdam earned in a year. By the end of that week, the market for tulip bulbs in the Netherlands had broken. This is the first speculative bubble historians have a clear record of. We've had at least 40 more since. Here's what tulip prices in the Netherlands actually did between 1635 and 1637. Slow at first, then it bends upward, then it goes nearly vertical. That last part, the part where reasonable people lost their judgment, lasted about 3 months. At the peak, contracts for the same bulb were changing hands 5 times a day. After the crash, those bulbs took a long time to find a floor. Within a few years, they were trading for around 1 or 2% of what they'd hit at the top. Now here's the Dow Jones from 1920 to 1932. The Dow climbed 6-fold over 8 years, from 63 points in 1921 to 381 on September 3rd, 1929. 3 weeks before the crash, the Yale economist Irving Fisher told a group of bankers that stock prices had reached, in his words, what looks like a permanently high plateau. On October 29th, the Dow lost 12% in a single day. By July of 1932, the index was down 89% from its peak. Investors who held through that crash didn't see their money come back until November of 1954. 25 years. And here's Bitcoin from 2017 to 2023. Slow climb through 2018. Pandemic era surge through 2020. Peak on November 10th, 2021 at $68,789 per coin. 12 months later, it bottomed near 15,000, down 78%. Across the whole crypto market, more than $2 trillion in paper wealth had evaporated. A flower market in 17th century Holland, the New York Stock Exchange in 1929, a digital currency in 2021. 3 centuries, 3 completely different assets. But when you scale them all to the same axis, you get almost the same curve. On this channel, we'll come back to this shape often. We call it the spike. Once you've learned to recognize it, you start seeing it everywhere. For this video, I pulled together price data on 40 distinct speculative manias going back to those tulips in 1637, Britain's South Sea Company in 1720, the Mississippi bubble in Paris that same year, which destabilized French public finance for decades, Britain's railway mania in the 1840s, Florida real estate in 1925, Japan's asset bubble of the late 80s, when the grounds of the Imperial Palace in Tokyo were estimated to be worth more than all the real estate in California, the dot-com crash, the 2008 housing collapse, 2 cryptocurrency cycles, NFTs, meme stocks. I aligned each one at its peak, the moment the curve broke, and looked at what the 40 had in common. 3 things show up almost every time. The first is cheap credit. Bubbles run on borrowed money. The 1920s ran on margin loans, where retail investors put down 10% of a stock's price and borrowed the other 90% from their broker. The 2000s ran on subprime mortgages and the derivatives stacked on top of them. The 2020s ran on near zero interest rates and trillions in pandemic stimulus. The credit comes first, the mania follows. The second is a story that explains why the old rules don't apply this time. Railroads will reshape commerce. The internet has made geography irrelevant. American housing prices have never declined nationwide. Crypto is digital gold. These stories are usually half true. That's what makes them work. The third is about who's buying near the top. There's an old story about Joseph Kennedy. Yes, the father of John F. Kennedy, who in 1929 supposedly got a stock tip from a shoe shine boy outside the New York Stock Exchange and took it as a sign to sell. He may have embellished the story later, but every bubble has its version of it. In 1999, it was dentistsdaytrading.com stocks. In 2021, it was college students using leverage to buy Dogecoin. The detail changes, the pattern doesn't. Which brings us to today. This is the share of total American household financial assets currently held in stocks. Federal Reserve data going back to 1952. In the first quarter of 2024, that number hit 41.6%, an all-time record. Higher than the late 1990s peak before the dot-com crash, which reached 38.4%, higher than the 2021 peak of 41.5% before the crypto and tech sell-off. Higher than any reading the Fed has ever published, going back over 70 years. This doesn't mean a crash is coming next month. The shape of a bubble can't tell you when the curve will break. The Dutch tulip market climbed for 3 years before it broke. The Dow climbed for 8. Bitcoin climbed for nearly 4. What the shape can tell you is what's underneath. So the question worth asking isn't whether we're in a bubble. It's something more specific. Where on the curve are we? In 1986, an American economist named Hyman Minsky published a book called Stabilizing an Unstable Economy. He'd spent decades studying financial crises, and what he found was that bubbles aren't random events. They progress through stages, and the stages happen in roughly the same order every time. Minsky identified 5 of them. They map onto this curve like a clock. Stage 1 is what Minsky called displacement. Something in the world changes, like a new technology, a war ending, a central bank cutting rates. The change creates a real opportunity to make money on something that didn't exist before. In the 1990s, the displacement was the commercial internet. In the 2000s, low mortgage rates. In the 2020s, near zero interest rates plus pandemic stimulus. This part is rational, the story is true. Stage 2 is the boom. Early investors make money. Other people notice. New buyers come in, prices rise, and critically, at this stage, the rise is mostly justified. Internet companies really were going to change commerce. Houses really were a good investment in 2002. Bitcoin really was a working monetary system. The fundamentals support the price. The story still holds. Then comes stage 3. Euphoria. Prices climb faster than anything in the underlying business can justify. People who've never bought this kind of asset before start buying it. People who can't afford to lose money start borrowing money to buy it. And the phrase that gets repeated in every euphoria phase across history is some version of "this time is different." This is where the smart investor's discipline tends to break. The numbers don't make sense, but the prices keep rising, and watching everyone else get rich is harder than it sounds. Even Isaac Newton sold his South Sea shares for a profit early, watched the price keep climbing, bought back in near the top, and lost most of his fortune. Stage 4 is harder to see while it's happening. The investors who've been in the market longest start quietly selling. Prices keep rising for a while because new buyers are still arriving. But underneath, ownership is shifting from the people who got in early and know what they're holding, to the people who showed up late and don't. And then stage 5, panic. Sometimes there's a clear trigger, a bank failure, a regulatory change, a piece of news. Sometimes there isn't. Confidence breaks. Selling becomes rational. And then it becomes mandatory because investors who borrowed to buy are getting margin calls and being forced to sell whether they want to or not. The asset that was supposed to make everyone rich destroys most of the wealth it created. Sometimes in months, sometimes in days. 5 stages. They've shown up in every one of the 40 manias I tracked. They'll show up in the 41st. There's a line in the book of Ecclesiastes, written something like 3,000 years ago, that reads, What has been will be again. What has been done will be done again. There is nothing new under the sun. Whoever wrote that had never heard of Wall Street or Bitcoin or speculative manias in any form we'd recognize, but they would have understood the curve. On this channel, I'm going to trace patterns like this one across history. Empires, currencies, monopolies, generations, debt cycles. If you want to see how it all connects, subscribe.